Have you ever looked at your company's stock price and, thought, what if I could own a piece of this? Not just work here, but actually invest in its success and maybe even get it at a discount. Imagine an investment where you're almost, guaranteed a profit the moment you buy. That sounds almost unbelievable, right? But that's sort of the reality of an employee stock purchase plan, or ACP. So today we're not just dissecting some financial instrument. We're really exploring a powerful way towards ownership, a way your hard work can, translate directly into tangible wealth. We'll start by digging into this idea of discounted stock. Then we'll walk through the practical steps, how you actually participate. And finally, we tackle the often confusing part, the tax implications. By the end, you'll see why this benefit, which sometimes gets overlooked, can be a really strategic, low-risk way to build wealth tied right to your company's growth. Okay, but before we dive deeper, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, explanations, everything we talk about here comes from the accounting resources over at farhatlectures.com. So whether you're an accounting student, a CPA candidate, or already a professional, you should definitely visit the website. They've got extra practice questions, video lectures, and detailed support to really help reinforce today's topic. Special thanks to Professor Farhat for providing all this valuable material. All right, so we hear a lot about employee stock plans generally, but what makes an ESPP specifically distinct? Is it just another way to buy company stock, or is there a unique edge?
Yeah, that's the key question. And what's truly fascinating here is that an ESPP is essentially a right the company gives you, the employee, to buy shares. But, and this is the crucial advantage, it comes with a significant discount. So unlike just going out and buying shares on the open market, an ESPP lets you get them at a price lower than their current market value. That's the main differentiator. And honestly, the real genius of it is that it's one of the few ways for, the average employee to get what's pretty much a risk-free immediate return.
Risk-free, really?
Well, virtually. That initial discount isn't just a perk. It's like a built-in advantage that significantly de-risks your entry into owning that stock. I actually remember this vividly. Years ago, I worked third shift at Walmart.
Oh, yeah.
And you'd go into the restroom, seriously, and there'd be signs showing the current stock price. And right below it, something like, your next depends on you. It was this constant reminder that you kind of owned a piece of the company.
Huh. Interesting motivation tactic.
Exactly. The idea was, work harder, the stock goes up, you benefit. Very tangible. And I've also handled these plans, ESPPs and stock options, from the other side during my time at Merrill Lynch. So yeah, I've seen them from both angles.
That is powerful. It really does go beyond just getting cheaper shares. It's about aligning your own financial success with the company's success, isn't it?
Precisely. When the company does well, you directly benefit. It creates a really strong incentive.
Okay, so that immediate discount sounds incredibly appealing. But how does an employee actually get access? What's the, step-by-step process from deciding, yeah, I want in, to actually holding those shares?
Right. It's quite structured, usually. First, there's what's called an offering period. You can think of that as the grant date, basically. It's a specific window when employees can sign up, can enroll in the plan.
Okay, the enrollment window.
Exactly. Once you're enrolled, you decide how much of your paycheck you want to set aside for buying stock. So, for example, if you make, say, $2,000 a week, you might choose to deduct $200 each paycheck. Now, that money doesn't buy shares immediately. It goes into what's called an escrow account. It's essentially your money, but the company holds it specifically for these stock purchases.
Okay, so it accumulates.
Yeah, it builds up. Then, at a later point, typically at the end of a quarter, you hit the exercise date. That's the day you can actually use the money in your escrow account to buy the shares.
Okay. And that's where the discount comes in.
That's where the magic happens, yeah. Companies usually offer a discount, maybe 10%, sometimes 15% off the market price. And what's really beneficial for employees, this is where that virtually risk-free part comes in strong, is that many companies use a look-back feature.
A look back. What's that?
They'll calculate your purchase price based on the fair market value of the stock on that day, the exercise date, or the fair market value back on the offering price date.
Okay.
And they use whichever price is less.
Oh, wow. So you get the benefit of the lower price over that period.
Exactly. It gives you the best possible deal. It pretty much guarantees you're buying at the lowest recent point plus the discount.
Okay, let's put some numbers on that. Give me an example.
Sure. Let's say the stock price on your exercise date is $64.15, and your company offers a 15% discount. So you'd pay 85% of that price.
Right. 100 minus 15.
Right. So instead of paying the full $64.15, you'd only pay $54.63 per share.
So you made almost $10 a share instantly.
Instantly. It's a built-in gain right from the start just because you're an employee in the plan. It's like Buying something on sale knowing it's already the lowest price it's been, and you get another 15% off that.
That flexibility with the discount, picking the lower price, that really does seem like a huge win for the employee. It almost sounds a bit too good to be true, which usually means there are rules, right? Specific conditions to get those benefits. What makes an ESPP qualified in the eyes of, say, the IRS, and what are the key criteria we need to know?
Precisely. You hit the nail on the head. To unlock those really good tax advantages, the ESPP needs to be qualified. And in terms of tax treatment, it's very similar, draws a clear parallel to incentive stock options, ISOs.
Ah, okay, ISOs, right.
Yeah, another type of employee stock grant, often seen in startups, that also gets special tax treatment. So think of qualified as the IRS saying, okay, this is a great benefit, but it has to follow some ground rules. These rules ensure it's genuinely for broad employee benefit, not just loophole for a few executives.
Makes sense. So what are those key rules?
Well, the most important ones for you, the employee, are probably these. First, the plan generally has to be offered to most full-time employees. There can be some exclusions, like for highly compensated people or brand new hires.
Like your Walmart example, right?
Yeah.
You couldn't join right away.
Exactly. That's why. I hadn't hit that 2-year employment threshold they likely had. Second, there are limits. You can only acquire up to $25,000 worth of stock per year under the qualified part of the plan, based on the value at the grant date.
Okay, a 25K annual limit.
Yep. And third, this one is critical for getting the best tax outcome you have to hold the stock for specific periods. You need to hold it for at least 1 year after you exercise the option and buy the shares.
1 year post-exercise.
And it has to be at least 2 years from the original grant date or the offering date.
2 years from the start date, got it.
Right. It ensures you're not just flipping the stock for a quick profit, but you're more of a long-term stakeholder. So just to use some dates, if the offer was, say, September 1st, 20x2, and you exercised September 1st, 20x3, you'd need to hold that stock until at least September 1st, 20x4 to meet both requirements before you sell.
Okay, that's clear. Holding periods are key.
Definitely. And there are rules for the company too, of course. Like the plan needs to be written down, approved by shareholders, and the exercise price has to be at least 85% of the fair market value, either on the grant date or exercise date, whichever is lower. That reinforces that maximum 15% discount.
Right.
If you really want to get into all the nitty-gritty regulatory details, FarhatLectures.com has a super comprehensive breakdown of every single rule.
Good to know. So it really seems like the government wants you to commit, doesn't it? Be a loyal long-term shareholder to get those best tax rates?
Yeah, you could see it that way. Encouraging good financial habits, perhaps.
Okay, so let's talk taxes directly. That split you mentioned between ordinary income and capital gain.
Yeah.
That feels like where it gets really important for the employee's bottom line. Could you walk us through maybe a practical scenario, put some numbers to it, help us see exactly how those gains get categorized and what it means for the tax bill?
Absolutely. This is crucial for your personal finances. And the great news, generally, for employees, is that you are not taxed when the option is granted. Nothing happens then. And you're also generally not taxed when you exercise the option and actually buy the shares.
Okay, no tax at grant, no tax at exercise. That's good.
Right. The tax event, the moment you actually have to report income or gain, happens only when you sell the stock.
Only at the sale.
Only at the sale. And an interesting side point. If you didn't recognize any income up front, you generally can't recognize a loss either if the stock price drops before you sell. Now, when you do sell, here's that crucial distinction for taxes. The initial discount you received, remember that benefit you got just for being an employee.
Yeah, the 15% or whatever it was.
That part is taxed as ordinary income. Think of it like extra salary, taxed at your regular income tax rate.
Okay, the discount is ordinary income.
But any additional profit you make, from the stock actually growing in value after accounting for that initial discount, that part is typically your capital gain.
And that's usually better tax-wise.
Often, yes. Especially if you've held the stock long enough to qualify for long-term capital gains rates, which are usually much lower than ordinary income rates. So you generally want more of your profit to fall into that capital gain bucket.
Okay, let's use an example. You mentioned John earlier.
Perfect. Let's walk through John's situation. So John gets an ESPP offer. He can buy 200 shares of his company's stock at an exercise price of $90 per share. On the day he got that offer, the grant date, the stock's fair market value was $100 per share.
Okay, so he's got a $10 per share discount baked in right there.
Yeah.
$100 FMV, $90 price.
Exactly, a $10 inherent discount. Then later, on April 3rd of year two, the stock price is up to $120. That's when John exercises his option and buys the 200 shares for $90 each.
Still paying the
Still
$90.
paying the locked-in $90. Now, John is smart. He holds onto the stock. He waits until May 10th of year three, making sure he meets those holding periods we talked about, and then sells all 200 shares for a fantastic $180 per share.
Wow, $180. Good for John.
Definitely. So first question, did John report any income back on the grant date?
No, you said nothing happens then.
Correct. Nothing recognized. He just got the right to buy. Okay, next. What's John's adjusted basis? That's basically his cost for tax purposes.
Well, he paid $90 per share for 200 shares, so $18,000.
Exactly. His basis is $18,000. That's his investment amount. Now for the big moment, the sale. What's the amount and type of income John reports? He sold 200 shares at $180 each. So total proceeds are
200 times 180, $36,000.
$36,000. And his basis was $18,000, so his total gain is...
$36,000 minus $18,000.
Yeah.
That's $18,000 total profit.
Correct. Total gain of $18,000. Now, here's the critical split we need to make for taxes. How much of that $18,000 gain is ordinary income?
You said it was the original discount. So that $10 per share difference between the $100 FMV at Grant and the $90 he paid.
Precisely. That $10 discount per share times the 200 shares he bought.
10 times 200.
$2,000.
$2,000. That amount is recognized as ordinary income. Tax just like his salary.
Okay, $2,000 ordinary income.
Now, the rest of the gain is the capital gain. His total gain was $18,000. We subtract the $2,000 ordinary income portion.
Leaving $16,000.
$16,000.
Yeah.
That remaining amount is his capital gain.
And because he held it long enough, it's likely long-term capital gain.
Yes, since he met both the 1 year from exercise and 2 years from grant holding periods, that $16,000 would typically qualify for long-term capital gains treatment.
Which means a lower tax rate on that $16,000 compared to the $2,000. Exactly. That $16,000 difference is where the real leverage often comes in. It really shows how patience holding on to the stock can literally pay off with the tax authorities. This split is just incredibly important for tax planning.
That example makes it crystal clear. You carve out the initial discount as ordinary income, and the rest the actual appreciation. That's your capital gain. Huge difference.
Yeah.
Okay, now what about the company, the employer offering these plans? What are the tax consequences for them? Do they get a tax deduction for providing this benefit? It seems generous, so why do they do it if there's no tax break?
That's a great question, and actually it's a very straightforward answer from a tax perspective. The employer receives no tax deduction for a qualified ESPP.
None at all.
None. Why not? Well, think about it from the company's view. They're simply issuing shares of their own stock. The employees are using their own earned money usually deducted from their paychecks, to buy these shares.
Right. It's employee money buying the stock.
Exactly. So it's not treated as a compensation expense for tax purposes in the same way salary is, even though the employee gets a discount. The company is facilitating a stock purchase for its employees, not directly handing out taxable compensation at the grant or exercise point that would justify a deduction for them.
Okay, that makes sense from a tax accounting standpoint.
Yeah.
So then why do they bother if there's no direct tax write-off for the company?
Well, it's about much more than just a tax deduction. It's really a strategic tool. Think about fostering employee loyalty, retention, alignment with company goals.
Right, the softer benefits.
Exactly. When employees actually own a piece of the company, even a small one, they tend to be more engaged, right? Maybe more productive, more likely to stick around. It turns employees into stakeholders, directly incentivized by the company's long-term success. Plus, it can be a real competitive advantage when trying to attract top talent.
Yeah, I can see that. It's a benefit that stands out.
Definitely. So, while there's no immediate tax write-off for the company, the indirect strategic advantages are often seen as really substantial.
So it's more of an investment in their people, in human capital, and driving that long-term performance, not just a tax maneuver.
You got it. That's a perfect way to put it.
Okay, great. So we've really covered a lot of ground today in this deep dive on employee stock purchase plans. We've seen how ESPPs are this powerful, maybe sometimes overlooked benefit. It lets employees share directly in the company's growth, especially with that fantastic built-in discount. We walked through the core mechanics, the offering periods, payroll deductions, that crucial exercise date, and importantly, we broke down the specific tax treatment, hitting hard on that key difference between ordinary income from the discount and capital gains from appreciation when you sell. Understanding all these pieces is really essential for anyone thinking about or already in an ESPP.
Absolutely. And, if we just zoom out for a second, connect this to the bigger picture, an ESPP isn't just a financial thing, is it? It's really a tool for building that employee loyalty, that alignment. It turns employees into genuine stakeholders, which maybe raises a bigger question for companies and employee alike. How else do companies incentivize people to truly own their roles, even beyond direct equity like this?
That is a really interesting thought to leave folks with. Something beyond just the stock plan itself. So for you, our listeners, we hope this deep dive helps you figure out if an ESPP could be a smart move for your own financial strategy. Or maybe it just prompts you to take a closer look at the benefits your own company offers. And remember, if you wanted to explore more on this topic or really any accounting concept, you can always visit farhatlectures.com. They have tons of additional resources, practice questions, and detailed support to really deepen your understanding. Thanks so much for joining us for this deep dive.